Are you chasing returns? What's that even mean? Well, for a lot of investors, a lot of people I've met along the way, I wouldn't even call them investors. They're just people who are chasing returns. And essentially, they're just trying to make as much money as possible, which is fine. Unfortunately, what they're willing to do to get that money generally doesn't make any sense. They want to buy things that they presume have high returns because they have had high returns in a lot of cases, or that they heard that they should have high returns. But that's it. That's all they have. That's all they have to go by. And so I'll give you a few examples. So one of the things that I've seen people buy is something like Tesla. Tesla's an incredible company. They've made a lot of people a lot of money. So they buy Tesla when it's low, they sell it when it's high, right? That's what you want to do. But because they heard that somebody else made a lot of money buying Tesla, what did they do? They bought some Tesla also. Now they don't have any presumption other than the fact that somebody made some money on Tesla and they made a lot of money. So apparently that's going to continue. And, and the bad thing is sometimes it happens. Sometimes it does keep going up, but they don't have any idea about the company, about the stock, about why it should go up or why it should not go up. What are some of the scenarios that might cause it to go down, or what are some of the scenarios that are going to cause it to go up? So if it goes up, they don't know if they should continue to hold it or to sell it. And what happens? Generally speaking, there's a certain level of overconfidence that occurs when success is found, right? You've made some money. Somebody told you to come out and buy Tesla because it made them some money. You did it. And now you're up, and you're up a bunch. But you don't know anything other than you're up a bunch. Should you buy? Should you sell? Should you hold? Who knows? You don't. And it's not the only thing, right? There's, I have so many examples of, just Tesla, people buying it at the worst times, right? They bought it at a good time. They bought it early, relatively speaking. Stock goes up, they sell it. Good for them. They made some money. Of course, the amount of money that they put into it was relatively low amount, but they made some money in it. The bad thing is they see it keep going up. So what do? They get back into it with more money because they're not only have they bought back what they originally bought, they go back with more because they feel confident that it's going to keep going up because it's done nothing but go up in their history, in their brief history with the company. Invariably, inevitably, it comes down. And it's, Tesla's a great story. It's a great story for anybody who's held it for any amount of time. But when you don't know what you're getting yourself into in any level, are you making a trade or are you investing? If you're making a trade, what are the circumstances of that trade? If you're making an investment, what are the circumstances of your investment? What are you hoping to get? Are you willing to hold it for the long haul? These things are important things to know before you get into it. Now, yes, you can change your mind along the way, but you need to start with a basic understanding of what you're getting involved in. Now, yes, hey, there are going to be people that you trust, people that know more things about certain things than you do, and so you might get involved for that reason. But you also need to understand from them. Ask them, okay, hey, I believe you. I think Tesla's a great company or a great trade, and I'm going to buy in. So tell me when I should sell. What's going to happen to make it go up? What's going to happen in the long run that's going to make Tesla worth what I'm paying for it today? These are important things to know. And there's other things, of course. You have, I think things like Bitcoin. Hey, Bitcoin has made a lot of people billions of dollars. But is it going to make you billions? At this stage, probably not. But can it make you money? Maybe. Why would it make you money? Understand these things. Understand why it's going to make you come out ahead in the end. So, I mean, how do you let's talk about Bitcoin a little bit more, or cryptocurrencies in general. Now, there's certainly differences between the cryptocurrencies, and I don't want to bundle them all up. But if you think of them as a commodity, as something, I mean, there's no difference between one Bitcoin and the next, right? Now, there's a difference between cryptocurrencies, but just like when you're buying oil, a commodity, there's nothing really to distinguish this barrel from that barrel. I mean, yes, there's light, sweet crude, and there's these little things that might distinguish oil. But when you're buying wheat is wheat. Well, there's certain types of wheat. Yes, but the grain, we're talking about commodities here. So is Bitcoin at this point, or any cryptocurrency, essentially a commodity? How do you make money in a commodity? Well, by buying and selling. That's it. If you hold on to gold, there's the classic commodity for you, right? Well, you can have nice designs on your gold, and nice jewelry made of gold. That, in essence, the gold you start with is the gold you end up with. If you go out and buy 10 ounces of gold, in 1,000 years, you are going to have 10 ounces of gold, or your family will, right? It doesn't change. It's a commodity. So if you own one Bitcoin today, yes, it might be worth more dollars in the future. But the fact is, you own one Bitcoin. It shouldn't, if it's a commodity, I'm no Bitcoin expert. If it's a commodity, owning one means owning one. It's not going to increase its value. It's going to be the same. There's nothing inherent about Bitcoin that should make it increase in its value. Like, let's say you have a company. The company is there to grow and get bigger. So if you own a percentage of the company, as it gets bigger, that percentage gets bigger. But if you own a commodity, that's not necessarily the case. Now, yes, if you believe the demand for a cryptocurrency such as Bitcoin is going to increase because it's going to become, let's say, the default currency of the world, right? And in a way it is, right? Bitcoin became the default currency of the underworld. That's kind of where it got its value. And I'm not making judgments. I'm just saying that this is how something that was worth nothing, essentially, gotten up to $30,000, $40,000 a unit, right? So there is something, right? If you believe that Bitcoin will continue to grow in acceptance, and not just acceptance, in usage, right? People are going to be using it more. Well, then yes. Okay. Perfectly fine. Do you understand that? Do you understand that before you buy Bitcoin? If you understand that, you don't have to take my understanding of it. You can take other people's. I mean, you come up with your own. But as long as you have something that makes there's something going on in the world that will cause the things that you own to grow in value, I think it's legitimate to consider that an investment. That would be the only way I think you can consider it an investment. Anything, in any kind of purchase like that. Because, like I said, one Bitcoin is one Bitcoin. Now, one share of stock is different, right? That's why it's a little easier to get to the idea that investing in a company is a real investment. And sometimes what I like to tell people is what you're doing is basically speculating. If you're looking for an increase in demand, and that's what it would be, right? If people started using Bitcoin more, you're looking for an increase in demand. You are speculating. Now, stock that's really kind of how it's built in. If you have any education on valuations of companies, or even bonds or anything like that, what they're looking at is this stream of income, right? A company has a stream of income associated with it. And based upon that stream of income, and of course discounted back to today, that's what the value of the company should be. Now, there's a market. So there's what a market means is there's a lot of people with differing opinions about what a company is going to make, one, and how to discount that back, because the required rate of return will depend on who's looking at it. Some people, will see a Tesla and say, I need to get 15, 16, 17% back based on this future stream. And other people will have a lower number. And that's fine. That's how we make a market. That's how we, these things come about. That's why there's constant trading, right? Because people look at things differently. And things are changing differently. Sales figures come in. Interest rates change. Or just articles come out, right? There's an article about how wonderful Tesla is. Stock price might go up because more people are interested in the stock. They're made more aware of it. Or a negative report comes out and maybe the stock market goes down, or maybe Tesla stock goes down because there's a negative report about electric cars. So these things all play a role in all these things. But what we're really getting back down to, and what this video is about, it's about not buying into things because you want to make a lot of money, but buying into things because you understand how you're going to make a lot of money in anything that you buy and what's required for that to occur. It's amazing. There's two things that cause people to chase returns, right? One is overconfidence. They have done really well. They've done far better than they should have because, things sometimes just go well. If I sit there and I tell somebody, hey, you should expect to make about 10% a year, some years you're going to make 50%, some years you're going to lose 40%. But in the end, after a long series of years, you're probably going to make around 10%. That doesn't stick. That never sticks in anybody's head, right? When things are going well, they want to invest more. And not only do they want to invest more, they want to invest in the riskiest things they can find. Unfortunately, they're not the only people that do this, right? They're going out and they see, oh, I made 20% last year, but if I would have bought into robotics or cloud computing or AI, I would have made 50% or 60% or doubled, right? If I would have bought into Tesla, I would have made 100%. Unfortunately, that happened in the past. That valuation may or may not be good now. That valuation may have taken everything out of it, all the value out of the company. But do you know? Have you done the calculations? If you haven't, then what are you buying into? Are you just hoping? Are you hoping that the past will be the future? If that was the case, we all have, endless amounts of money. Excuse me. But anyways, that's one of the most common ways. The second most common way, you lose. And now you lose money. And now what do? You need the returns in order to make up what you've lost. And this is actually, this can be a good thing, I guess. Because, there's some investors, that's what they're looking for. They're looking for the market to crash. They're looking for stocks to crash. They're looking for things to go bad to enter the market. Oh, the market's down 20%. The market is down 30%. It's time to get in. All right? There's something to that too. Just like there's something into not jumping into something that's done really well. There can be something into buying things that are at a discount. But once again, what do you need to do? You need to do the calculations. If you're looking to time the market, it's very, very difficult. There's all these adages, right? What are some of them? Time in the market is more important than timing the market. And yeah, you can buy at the worst times, but if you have this long time horizon, if you didn't, if you're diversified and you bought into this long time horizon, I'm willing to be in this for 12 years, 15 years, 20 years. I don't care. You're going to be okay if you're diversified. Now, yes, you can go out and buy the riskiest of risky stocks and lose everything. Companies can go bankrupt and do. Companies go from 100 to bankrupt. It happens. So yeah, you need to have an idea of what you're doing and what's going on. You can't just buy things in the hopes that you're going to make money. You need to understand about diversification. You need to understand about the companies you want to invest in. You want to understand about investing horizon, making sure that you have the proper investment horizon when you invest in something. If you buy a 10-year bond, you know what? It's probably a good idea to have a 10-year investment horizon for that instrument. If you're looking over your entire life, I don't know. There are some people out there who want to leave this world with as little as possible, but not run out until the end. It's very daring. It's very daring, and I don't know. I think it's romantic in their eyes that I don't know. That's not me. I don't get it. I think that's like a weird way to live life, leaving nothing behind. They want to the world owed me something, and I'm gonna leave with debts. Because forget these people. How dare they lend me money, and I'm gonna die owing, and then they're gonna get nothing. There are people like that. Are you one of those people? I mean, that's just a weird way to want to live life, to even think about that way. Now, you can't, you hear things like you can't take it with you. No, you give it to the people you love. You give it to the people you love. And then along the way, you don't have to worry about it. Your life going on too long and you running out and the debt collector is coming after you because you decided that you wanted to leave the world in debt. Crazy, huh? I no judgments here. Okay, maybe a little bit, but yeah, this is not me. So, but yeah, I mean, that's kind of the other thing too. Yeah, so you've waited too long in life. You see, you start investing, and this I see this with people. They want to retire early. They want to, or just retire. They're in their 60s, 50s, and 60s, and now they want to start investing. Well, just because you want to retire doesn't mean the returns are going to come to you. They don't just magically come to people because they want to retire. You have to make a whole series of good decisions. I've made the recommendations many times to people who, want to retire. I tell them essentially, you have a choice. First of all, if you're 60 years old, you might live until you're 100, right? That's 40 years. So yeah, if you want to go out and buy some stocks because you want to make sure those potential 40 years are the most you can get out of them, do so. Make it happen. But if you want to retire by the time you're 63 and you're 60 years old, Well, let's say you're 65 and you want to have a certain amount of money, then buying stocks isn't really the way you should be looking at it or doing it. You need that long time horizon. Longer the better. 12 years. It's not easy, right? It's not easy. It's not supposed to be. You're letting people use your money. And when they get it back to you, the more indeterminate that is, the longer your time horizon needs to be. But when you're in a rush to get your returns, then you start, it's easy to panic, right? It's easy to panic. And I've seen it happen. I've seen it happen time and time again where, someone's on a nice investment plan. They're investing monthly, a certain amount of money, $1,000, whatever, $2,000. And, things are going well. Okay. Stock market drops. Now, if they invest $1,000 or $2,000, they're actually getting more, right? They're getting more. But because the market dropped, they're afraid. So they stop investing. Or worse, they sell everything. And I've seen that too. Back when COVID wiped out, the stock market briefly, there are a lot of people who sold at the literal bottom. Think about all the money they had made. You're talking tons and tons of money. Now, yes, there was some government manipulation in there and all that. So, yeah, maybe they did the equation, but they sold everything. And they sold it at the bottom. And as many of you may know, the stock market bounced right back up. It was, I don't know. I don't know if people learn lessons about things that they don't have any idea. I had tons of questions, tons of about what people should do. And I explained to them very simply, if you had a long time horizon, this is why you have a long time horizon. Because bad things happen. Good things happen too. And you have to be around long enough for them all to happen. Because it's almost impossible to only be in for the good times. But it's very possible to only be in for the bad times because you get out. And then what do? You just are afraid. Right? You're afraid that you're always going to lose money. And you might just be the wrong kind of person to be in something like equities, if that's going to be your reaction. Because you could lose every time you invest because you panic every single time it drops. And then you lose your money. So yeah, it's possible. And if you're that kind of person, I can't ever recommend investing for you. At least investing in equities and stocks. Now, yes, maybe, you buy some interest, bonds. Okay, buy some bonds. At least you get some interest out of it. If you hold the bond to maturity, you're going to be fine. Maybe you have to be one of these people who only buys U.S. Treasuries. You're just not... You're not sophisticated enough to trust the market's going to work. And that's okay. That's it's unfortunate because you're going to cost yourself a lot of money in the end. I'm not going to go over the equations now. But, this is what we're talking about, chasing returns. Chasing returns, right? Chasing returns because you're overconfident. Chasing returns because you need the money. Chasing returns because you lost and you're trying to get it all back. Commodities and things like that. You can make money in almost anything. Trading almost anything. It doesn't have to have any, market behind it. It doesn't need to be a commodity. You can go out and buy, stuff at a yard sale and sell it for more, right? That's trading. It's not really investing. It's trading. That's okay. You can do it. It's just you need to understand what you're getting involved in. That's the most important thing. Make sure you're not acting emotionally when you're making trades, when you're making investments. Right? Investing isn't an emotional thing. You make investments to make money. So be rational about things. Make sure you understand what you're getting involved in. And there's different levels that are required based upon how intricate your investing is. We'll talk about that some other time. I thank you for watching. Make sure you're not chasing any returns.